Home office tax deduction script. Most people are leaving thousands of dollars on the table every single year. The IRS literally lets you write off your home office. But 90% of remote workers and freelancers don't claim it. Today I'm showing you the exact method to do this right so you never get audited. Look, I know taxes are boring, but this one deduction can save you between $2,000 and $5,000 annually. Depending on your situation, that's money going directly back into your pocket instead of the government's. The key is doing this correctly. The IRS watches home office deductions closely because people cheat on them constantly. But if you follow this framework, you're completely protected. Part 1. The two methods explained. The IRS gives you two ways to deduct your home office. Understanding both is critical because one might save you way more money than the other. First up, the simplified method. This is the easiest path. You multiply your home office square footage by $5. That's it. If your office is 200 square feet, you're claiming $1,000. Maximum deduction is 300 square feet, which equals $1,500 per year. Here's why people love this method. Zero documentation. You don't need receipts. You don't need to track anything. You calculate it once. Claim it. Done. The IRS isn't going to audit you over this because the numbers are so standardized. It's the safest play if you're nervous about red flags. But here's the catch. Most people should use the regular method instead. The regular method is where the real money is. Instead of that flat $5 per square foot rate, you're deducting the actual expenses of your home office. And this is generous. Let's say your home office is 300 square feet and your total house is 2,000 square feet. That means your office is 15% of your home. Now you can deduct 15% of your mortgage interest, property taxes, utilities, internet, insurance, rent if you're renting, maintenance costs, and repairs. We're talking potentially $8,000 to $10,000 per year if you own your home outright or have a mortgage. For renters, it's still $3,000 to $5,000 easily. Part 2. Calculating your actual deduction. Let me walk you through real numbers. Meet Sarah. She's a freelance marketing consultant in Austin, Texas. She owns her home. Her mortgage is $1,800 monthly. Her home is 2,000 square feet. Her office is 400 square feet. Sarah's office represents 20% of her home. Her annual mortgage interest is roughly $14,000. 20% of that is $2,800 deductible. Her annual property tax is $3,600. 20% is $720 deductible. Her annual home insurance is $900. 20% is $180. Her utilities average $200 monthly. That's $2,400 annually. 20% is $480. Her internet is $80 monthly. $960 annually. 20% is $192. Already we're at $4,300. And that's being conservative by only counting the big items. Sarah could also include home maintenance costs, WAF fees if applicable, depreciation if she owns the property, and even office furniture and equipment. Now compare that to the simplified method. Sarah would get $1,500 maximum. The regular method gives her at least $4,000 to $5,000, potentially more. Part 3. Keeping records and staying safe. Here's what separates people who get audited from people who don't. Documentation. Photograph your home office. Take clear pictures showing the dedicated workspace. The IRS wants to see that this isn't your dining room table. This is a legitimate office space. Get a timestamp on those photos. Keep all receipts for any home improvements or office equipment. A new desk, filing cabinet, office chair. Keep the receipt. If you paint the office walls, keep that receipt. Track your utilities. Take pictures of your monthly bills. Keep the statements in a folder. Same with mortgage statements, property tax documents, and insurance bills. These should already exist in your files anyway. Create a simple spreadsheet calculating your square footage percentage. Write down your home's total square footage and your office's square footage. This takes 5 minutes and becomes your baseline documentation. The IRS doesn't need you to submit these documents with your tax return. But if you ever get audited, you have everything ready. That's the difference between a successful deduction and owing money back. Call to action. This deduction exists. The money is yours if you claim it correctly. Whether you choose simplified or regular, you're coming out ahead. If you're serious about optimizing your finances, whether it's maximizing your 401k match at work, building your Roth IRA, or claiming every deduction you're entitled to, subscribe to this channel. We break down financial strategies that actually move the needle. Hit subscribe. Turn on notifications. Your future self will thank you.